Good morning. Welcome to the trade setup right here on BQ Prime. I'm Neeraj Shah. Let's take stock of the key market movements first. And the US markets may have ended the day lower, but the futures are trending higher, which is probably a good sign. Uh, in which case, the firm belief was that while there has been a bit of a rally, there will be a bit of a cool off, but ahead of the Fed meet, at least from a global markets perspective, there won't be too many differences or gyrations, and the markets will stay quiet. So we may have had a corrective move today. There might be a bit of a pullback today before the Fed actually announces what's wanting to do, and should, as a lot of people anticipate, that the Fed say that yes, we are doing 75 hypothetically, but the pace of increases will probably go down because the economy also has some issues and the inflationary pressures are cooling off a little bit. If that is the narrative, then the markets may take it well, and I do believe some of that is already in the price as well. But be that as it may, I think those are the pulls and pressures around what the Fed will do, and therefore what could happen to the US markets. The other cues, the dollar index, notwithstanding, that is at about 106. The yields continue to cool off at 2.80. I know it's showing an uptick of 0.58% at 7:30, but largely at 2.80, the number is subdued. Bitcoin, well, had a bit of a gain yesterday, and currently at about 21174. The SGX Nifty should come up on your screen next, and in line with what the US markets have done, on opposing moves there, yesterday down, today up. The SGX Nifty is kind of flat, but remember, we had a bit of a corrective move already. So the Nifty, after the fall yesterday, is now below its 200-day EMA at 16,524, and the range seems to be between 16,400 to 16,700 as per options data. Frankly, if you look at the call and put aggregate, the congregation seems to be around 16,500. But I think if you just broadly look at the broader range, until maybe tomorrow, 16,400 to 16,700 seems to be the outer and inner buckets around which the Nifty could be moving. FMCG and auto stocks, which have had a really good run thus far, are now starting to see some profit booking. Over the last 2 or 3 sessions ahead of expiry, we've seen fair degree of profit booking out there in most of these names, if not all. And on the conversely, metal stocks, which have been declining the least amongst all the other sectors, and maybe the trend continues till expiry. Yes, you could argue that Tata Steel had a slightly iffy day, etc. But if you just look at the index per se, if you look at the broader components and include stocks like Hindustan Copper or some of the others as well, we've seen a really strong, how do I say, fairly strong performance from metals compared to uh, most of the other sectors. So, which is actually a, a pretty good sign. So, yep, do watch out for it from that perspective. Could be interesting as well. I mean, I was looking at some of the quant research done by various brokerages, and so Hindustan Copper example from the metal space, OI increased, went up by 4%. OI was up 13%. Vedanta decreased by 6.3%, and the OI has decreased about 24% since last expiry. Rollover is also some 54% versus 61% last month. So metals are an interesting pocket at the current point of time. That being said, FIs continue to net sell, and that number, like I said last week, was probably a bit of an anomaly. We're back to what basics were to be dictating, and therefore that selling number continues. What about specific stocks? It's a long list, and we have graphics for most of these, but in some cases, you'll just have to hear me out. Let's start off with Larsen and Toubro, and the opinion is divided right down the middle. Now, look at these numbers first. Revenues up 22%. EBITDA margin at 8.7%. I know the management talking about 11%. We don't include other income in our calculations. And according to our math, EBITDA margins at about 8.7%. Net profit, there were, how do I say, some one-offs, if you will, or if not one-offs, some other factors, comparatively higher other income and finance cost came down, as a result of which there was a larger jump in the net profit numbers. They don't get included per se in the EBITDA margin calculation, as a result of which EBITDA margins are lower according to our math, but net profit is higher. Brokerages have been mixed about this one too. So Jeffries came out with a very flying note on L&T, saying that to bring home the leader. They are saying it's a buy with a target price of 2215. According to them, the Q1 revenues and EBITDA were 11% and 10% above expectations. Order inflow growth was strong at 57% YOY growth. The prospect pipeline is down 15% YOY, but management maintained its 12 to 15% YOY order flow and revenue growth guidance. And they believe it will continue to benefit from the execution and margin recovery as the negative impact of supply disruptions and sharp rise in commodity prices in 4Q continues to ease. Now, that is something that obviously everybody would agree with. But here are the other things, right? So you could argue that the order inflow, etc., was missing, right? But as Nomura says, there is a significant pickup in tendering, which leads them to believe that the 12 to 15% guidance given by the management and order inflow growth for FY23 would both be achievable. Now, could well happen, but let's wait and watch. I mean, at least everybody on the street seems to be believing that that's par for the course. There's also some murmurs of how there are some resolutions um, in the Hyderabad Metro project. And I haven't heard any official announcement, but piecemeal there are some resolutions that are happening, and some people are construing even that as positive. So maybe L&T has a half decent day today. Tata Power, revenues up 45%, net profit up 90% compared to estimates at least. Even the EBITDA came off quite significantly. The margins came off quite significantly. So a bit of a pickle here, but yeah, it'll be interesting to see how the stock does today. Shopper Stop, and we've used QOQ out here because it will be wrong to view a YOY comparison in Shopper simply because last quarter was a bit of a washout, right? Corresponding quarter last year because of the wave. But on sequential basis, Shopper Stop has come out with flying colors. Revenues up 33%, EBITDA up nearly 2x, slightly more than 2x actually, at 162. Margins improving 17%, net profit versus a loss. So in some sense, it's done well. You would argue again on expected lines that even Q1 this year, or rather the Jan to March quarter, was also impacted by a COVID wave, and therefore a QOQ would also not be a completely fair comparison. But for the business that we're talking about, I would reckon that QOQ is a better comparison than YOY at least, because at least Feb and March had some normalcy. And therefore that is probably the best that I could think of. But I thought the numbers looked okay. United Spirits, it's a mixed print, but I thought that, and a couple of brokerages said that it was okay. But JP Morgan on USL was interesting. They say that the Q1 revenue fell short of their and street expectations. The P&A volumes were subdued with the 3-year volume CAGR at only -1%. That's quite something, which is impacted by constraints in Scotch supplies in select markets. EBITDA margin was below expectations on account of revenue miss, even as gross margin was in line. And by the way, that's at a multi-quarter low due to the cost of goods sold inflation being seen. And they expect a negative share price reaction to this subdued print. That is the JP Morgan view. I thought from amongst the 2 or 3 notes that I read, this one made the most valid arguments, not on the stock price reaction, but the others. The stock price reaction is their view, which I'm bringing to you. If it does react accordingly, you would know why that is the case. So watch out for this. We'll of course be talking to the management only later on. I think on Friday or Monday is when they're talking, but it will be an interesting conversation, and I sure will be wanting to get some explanations around some of the things that they have reported. Mixed numbers from the 2 AMCs. So Aditya Birla AMC, revenues are up 1%, EBITDA flattish, EBITDA margin flattish, net profit down 33%. But broadly on the revenue and the margin front, it was a fairly flat quarter. But compare that to what UTI did, kind of all over the place. Revenues were up 15%, and compared to Bloomberg estimates higher. EBIT though fell 50% and much lower than Bloomberg estimates. Margin fell to 33% versus 55%. Net profit fell 39%, at 94 crores versus 155 crores. So you could argue that it's a fairly mixed print between both of these. Difficult to call what the intricacies are. I'm guessing it's got to do with a lot of the quantum of sales of select products and select line items that each of the AMCs would have done, which would have led to the kind of EBITDA performance and the profit performance between both. But yeah, maybe a bit of a non-event or maybe a bit of a negative reaction in a couple of cases there. Speaking of negative reactions, some results, which were below estimates, Relaxo Footwear and Sanofi, both of which seem to have some wrinkles. So Relaxo, the Q1 PAT was at 38 crores versus the estimates of 68 crores. Sanofi EBITDA margins just collapsed at 23% versus 31%. So a bit of an issue out there. There are a few queries. We'll get to that in a moment. Zomato Blinkit deal proposal has been approved by the shareholders. Zomato is caught in the eye of a storm. Viewers, remember, there is also a belief that a large shareholder, since I don't have first-hand information, I won't spell out the basics, but the large shareholder, a large shareholder in Zomato, and that stake might be coming into the market soon, and that could be a fairly large supply, as a result of which there's continued pressure on Zomato. It's now close to, I mean, you're close to nearly 40 levels. So it tells you a story or two about how much some of these stocks have been derated. And in some cases, the derating is a bit more than others. So Nykaa hasn't had as much of a derating from the all-time high prices Zomato has had. I mean, this chalk and cheese performance out there, but be that as it may, Zomato is caught in the eye of the storm. Today, we'll be doing some analysis later on in the day on Zomato and what are the key pulls and pressures and what could be the way ahead. You might want to maybe see that on all our social media platforms. So Zomato clearly in the eye of the storm, and we would want to address that. So that will happen sometime in the day today. Something else, Embassy Office Park REITs, not apparently, Knight Frank report suggests that the Asia Pacific prime office rents have remained resilient in Q2 despite rising inflation, and Bengaluru has recorded the highest annual office rental growth in the APAC region, in the whole APAC region in Q2 at 12.1%. Now, that should augur well for companies which have got a large presence in the Bengaluru region in that space, and therefore Embassy Office Park REITs comes firmly in mind. There might be others too I might be missing, but certainly watch out for this one. SBI Cards is interesting. The reason I bring it up is because there was a long build-up seen, which was strong. The close price of SBI Cards is above the 200-day moving average, and in the July series, the stock has gained 15%, while OI has reduced 15%. Now, could it be that this MDR proposal that is being come out could be a UPI-based MDR proposal, could be good for the credit card companies, and therefore could it benefit SBI Cards? Maybe it could, and therefore watch out for this one as well. I'll watch out for Bharti Airtel and Asian Paints as well. Bharti Airtel, simply because if indeed the quantum of bidding ferocity for the 5G is at the reserve price and not too expensive, that could augur well for both Bharti as well as Reliance Jio as well, maybe, but Bharti most certainly, which is why maybe Bharti was resilient yesterday, viewers, vis-a-vis most of the other companies, right, in a dull day. The other one is Asian Paints, wherein brokerages have a mixed view, you would have to say, right? So most except for, okay, so Citi is neutral with a target price of 3,400. Credit Suisse is the one which is outperformed with a target price of 3,800. They are saying that while concerns over competition are valid, Asian Paints is looking to fortify its dominant position. But Morgan Stanley is underweight. They are saying that management remains hyper-focused on top-line growth, but the near-term inflationary headwinds remain, and the changing industry dynamics and lower margin profile will drive derating. There are only two things that, according to me, stand out. One is the pulls and the pressures. The pressure is this industry becoming one with very high competitive intensity, deep-pocketed players? Yes. Could it mean that some of these companies could see margin pressure and ROC pressure from where it is? Maybe it could. And would Asian Paints face? I mean, not just competitive intensity per se, but also if crude prices were to stay elevated, could there be margin pressures, because they've controlled this quarter the margin performance by virtue of expenses, employee expenses coming off, etc. There's only a limit to which these can be cut, right? And remember, these organizations have cut these expenses since COVID. So can there be a change there? So I think all of these things would be interesting to see. There are a couple of views on Syngene. Viewers, trust me, you got to see the Syngene interaction that we did last week. That will probably answer all the queries that you may have. I'm anyways not qualified to make a comment on stock price performances, so I won't. But I think watching that interview of Syngene would give you a lot of insight into what the management is thinking and where it could go. So try and do that. I think on the con call as well, as Unseen Value tweeted out, the last question gave a lot of insights onto that. But maybe the con call is not that easily accessible. A Syngene interview with BQ Prime is easily accessible, so do try and see that. View on Venky's, there's a talk of how chicken prices, etc., have slashed quite considerably. Maybe that has a bit of a top line impact on Venky's, so there could be some near-term pressure there. But I'm not an expert really, as I said. And what the stock does is anybody's guess, but I'm just giving you the basic fundamentals that maybe there could be some revenue performance issues there by virtue of what's happened to chicken prices. Apparently, chicken and egg prices both have come out quite materially. So do watch out for those pockets as well. Thanks so much for tuning in today. Remember, a clutch of management interactions lined up on BQ Prime today. We'll have Kishore Patil at 10 a.m., Praveer Sinha at 10:20 a.m., Amit Singhal of Asian Paints will be talking about all of the points that I just mentioned. So that will be at 12 p.m. And then the mutual fund show at 4 p.m. with Prableen Bajpai and Mohit Gang. So you might want to tune in for some of these. Thanks for tuning into the Trade Setup today.